My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be my friends. I'm just trying to make a little money. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Even on a decent day like today, where Dow gained 331 points, S&P climbed 0.51%, NASDAQ lagged plus 0.27%, I'm sure you have some positions, some stocks that you own that are treading water or being hit, especially some of those techs. And you're struggling to figure out if it's worth it to hold on to them or maybe move into the drug stocks or the banks or something a little more placid like the industrials. I get it. Back in my old hedge fund, we reviewed our positions 3 times a day. That's right, every day. 3 times a day, I'd have to defend them to Karen Cramer, our head trader. If my enthusiasm flagged at all, if there was a negative news story, a downgrade, a price target cut, or even if the stock was just heavy, where sellers didn't seem to care what prices they sold their stock at, she'd deem it vulnerable and kick it out, whether I liked it or not. Sell, 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 sell. It was brutal, but necessary. We were running out of the people's money. We had to contain our losses. They were looking over our shoulders. And when it came to dead money, forget about it. She'd say, let's boot it and come back at a better time. There are other stocks to own that can win. You see this attitude a lot from people who come on our network, don't you? They're running money aggressively. They can vacillate constantly. Sell. I did the same thing in my hedge fund. It served me well. But that's not how we run the charitable trust, the one you can follow if you belong, like so many of our callers, to the CNBC Investing Club. It's not the way you should manage your own money at home. You've got other things to do. You have no need to trade in and out of positions like crazy because you don't have any investors looking over your shoulder criticizing your every move. You can afford to find companies you believe in and stick with them as long as the facts don't fall apart on you. Now, that does require a great deal of faith in both management and the underlying business because invariably your stocks will go down and you'll want to give up on them because of the pain.
The house of pain.
But that's usually a mistake when you're not running money professionally. Stocks sell off for all kinds of reasons, and it's difficult to swap back into the good ones before they rebound. As long as the thesis hasn't changed, you must resist the desire to give up on your favorite stocks, no matter what you hear from the billionaire class and the hedge fund managers who want to cut their losses because they can't spare a spot on their portfolio sheets for what feels like a do-nothing stock. Which brings me to the most talked about stocks of the current era. NVIDIA, Apple, Amazon, and Tesla. Remember them? 4 companies with riveting stories and temperamental stocks. I like the first 3, not so much the 4th. Let me start with NVIDIA. Now, okay, bear with me here. Hardly an hour now goes by without some portfolio manager, some analyst who trimmed or dumped their NVIDIA positions. Why? Because it's too high. Sometimes I wonder if they even know what NVIDIA makes. Everyone agrees the stock has moved up a great deal. Many have sold it and bought it back repeatedly. That's great. I believe you should just own NVIDIA, not trade it, because I've come to believe in the CEO, Jensen Huang. I like their business. I believe in him when he says we're on the cusp of a new industrial revolution, and that AI revolution, it will be powered by towers of NVIDIA's chips, which happen to run at blazing speeds. Eventually, I could see them selling trillions of dollars of these chips because they give you everything you need for what's known as accelerated computing. And that's why we own NVIDIA forever for the charitable trust. Of course, we check our thesis constantly. This morning, I interviewed Rene Haas, the CEO of ARM Holdings, a company I like very much, close partner of NVIDIA, and point blank asked him if he believed in the new industrial revolution. He does. Maybe he's just talking his book. Everybody does it. Maybe I'm wrong about Jensen and Rene. But I do have a degree of faith in NVIDIA, and anyone who's believed in this stock long-term has indeed made fortunes. I will ask Jayshree Ullal, the CEO of Arista, who knows the space cold, about her conviction level later in the show. That's a winning stock, too. Of course, the stock of NVIDIA acts very heavy. And it peaked at the beginning of March. That was about 90 points ago. Now, should you have given up on the thing? Should you give up on it now? Now, what if I told you that NVIDIA stock basically did absolutely nothing last July through December of last year because it was digesting a huge move then and the market temporarily turned hostile? What if I said that's typical of the way the stock trades? Frankly, in this tape, you shouldn't expect much of NVIDIA when it reports in a little less than 2 weeks. If you can't handle the fact that it periodically goes in and out of style, maybe you're not cut out for individual stock picking. That's okay. Most aren't. How about Apple? All right, this has been a strap yourself to the mast stock for ages, and the last few months have been one of really the rougher rides I've experienced. Not only did you have to endure the endless reports that Apple's China business kept getting worse, reports that turned out to be false, you also had to hold on through multiple downgrades and price cuts, and oh my. Sell. All based on declining phone sales and the possibility of a cut to the full-year forecast. Instead, when Apple reported you got a better-than-feared result for handset sales and a strong forecast for the current quarter. The opposite of what everybody said many people said could happen. Now, if you had faith in Apple, the solid quarter was not a surprise. But few did. I know at times I thought I was the only one that left that did. Or the stock wouldn't have roared like that after earnings. Now, we have the Worldwide Developers Conference in June and the next phone in the fall, which could be chock full of AI and therefore a must upgrade for you and for me. I like those odds. Again, the toughest course of action, just owning Apple and holding it tight, turned out to be the best move, as it almost always is with the leadership of Tim Cook. Amazon's been difficult because there are so many moving parts, any one of which can sink the stock. Prime, web services, advertising, delivery costs, antitrust regulators who have it in for the company that's done more to give us low prices than anyone, save perhaps Costco and Walmart. Now, you may not realize it, but every single metric has improved markedly in the last year, especially time delivery, because Amazon's worked hard to change routes so you can get everything at I'd say a lot of stuff same day. By the way, web services is really thriving too, and that's where the money is. That was declining, and now it's shooting all the way back. We tend to yawn at these accomplishments. But the fact that all of these moving parts came together feels downright miraculous to me. But it's actually not a miracle. It's just how to be great management. Now, finally, there's Tesla. Now, this stock doesn't fit the pattern of the other three. First, Tesla's sales are going down, not up. Second, the estimates are going down, not up. Third, the stock's super expensive for a car or a tech company. Fourth, prominent execs seem to be jumping ship pretty constantly. Fifth, the bloom is off the electric rose in this country, at least for now. Sixth, I'm tired of hearing about Elon Musk's robo-taxi. Maybe one day it'll be a savior, but America isn't set up for him. And China wants to do it. They're going to do it cheaper and homegrown. Now, I know Musk is entertaining few. Everyone wants him on TV, right? I know he's a visionary. I'll even stipulate that if he's wrong about the technology, it's because he's just too ahead of his time. Doesn't matter. To me, Tesla doesn't pass the test the others do. The facts aren't on our side. So it's very hard to justify having faith in this one or the man. Here's the bottom line. You need to think about these kinds of challenges before you buy any stock, and most certainly before you sell any stock. You don't need to swap in and out of stocks constantly like a hedge fund manager. You just need to figure out which companies deserve your confidence, and you stick with them. Let's go to Betsy in Connecticut. Betsy.
Booyah, Jim.
Whoa. Booyah, Betsy. What's happening?
I love your show.
Thank you. Thank you very much.
I'm calling about Boston Properties. The stock has taken a real beating these past 5 years. I'm tempted to get in now, but the commercial real estate market is facing lots of headwinds, particularly office buildings in large cities. Do you think there is a buying opportunity now?
Well, I think Well, first of all, thank you for your confidence. I think you'd be reaching for yield. That's something I learned when I was at Goldman Sachs you never do. I literally think, and the stock has had a move here, but I literally think that what's happening is that people want a good dividend, and I want a safe dividend. Stick with the show later on. I think you're going to hear three of them that I think you will like very much. Let's go to Omar in New York. Omar.
Hey, Jim, longtime fan. Thanks for having me.
Thank you for calling.
I'm interested in DoorDash. No worries. As of late, DoorDash has been trading below $120, and Uber and Instacart have recently announced they're preparing a joint effort to take market share away from the fast food delivery giant. As an investor, is there any cause for concern regarding DoorDash's future outlook?
Okay, well, look, it's an expensive stock, but I believe in Tony Xu. I have believed in Tony Xu when it was private and when I owned restaurants, and I think he's doing a terrific job. I actually like the quarter. I think people were way too quick to say it wasn't great. They, I think, will be judged harshly. Let's go to Bill in Massachusetts, please. Bill.
Booyah, Jimbo.
Booyah, Bill. What's up?
About 6 months ago, we talked on the show about Vertiv Holdings, and it has doubled since then.
Yeah,
Jim,
it's good.
I'm very happy.
Good boy. Good boy, that one.
Thank you.
Go ahead. No new one?
Yeah, Jim?
Yeah, you're with me. Go ahead. What's up?
So what do you think? What do you think Vertiv's going to do at this point? Should I pick up some more? Should I wait?
No, you don't buy
after?
more. Here's what you do. After a 100% move, you can't buy more. What you have to do is you want to trim some. I think I would take 20% off. That what I want to do is make it so that you play with more of the house's money than you're doing. And by the way, I think the world of Vertiv and everyone knows that because Dave Cody's the chairman. I've been backing Dave ever since he really decided to kind of take it over. And we caught about an 80-point gain. Never shabby. All right, look, you don't need to operate your portfolio like a hedge fund manager. Just figure out which companies deserve your confidence and then stick with them. On Man Tonight, how is AI spending impacting one horse of a stockholder Arista Networks? I'm sitting down with the CEO after its post-earnings rise. Then I'm comparing Monster Beverage to Celsius Holdings, telling you which company comes out on top. Might be surprising to you because these energy drink stocks, they can be very fickle. And if you think that rates are ultimately headed lower, then it might be a good time to pick up a retail REIT, not an office REIT, but a retail one. I'm revealing the ones on my shopping list, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Despite the roller coaster action in the stock market, the demand for infrastructure that can power artificial intelligence never really went away. Take Arista Networks as a maker of high-performance networking equipment that's increasingly essential if you want tons of computing power for AI, among other things. On Tuesday night, Arista reported a strong top and bottom line beat, with management raising their full-year revenue forecast, which allowed the stock to jump 6.5% yesterday and a bit more today, as it should. The only problem, the stock's up more than 25% for the year. That's a high-quality problem, is it? Can it keep running? Let's check in with Jayshree Ullal, the bankable chair, president and CEO of Arista Networks, to get a better read of the quarter. Ms. Ullal, welcome back to Mad Money.
Good to hear from you, Jim. It's been a while.
Way too long. Jayshree, you did it again. Reported a monster quarter. I know there are other people in the networking business who are telling me that there's just not a lot of business going on, which made me think that you're getting all the business because, wow, what a quarter.
Thank you, Jim. I have to thank our wonderful products, technology engineers, and most of all, our customers for choosing us.
Well, let's talk about the fact that you have basically ventured forth not just Ethernet, but some people would just say dumb switches. They were never dumb. But you're working on a network as a service that can use all the knowledge that you have and really help companies beyond just anecdotal. I mean, you've got a great empirical set of data that works terrifically for artificial intelligence.
Absolutely. I think over the last 15 years, Jim, we've created this operating system called EOS, and we've built into it a network data lake architecture that enables a tremendous number of overlays for zero-touch automation, security, observability, and especially for this new wave of artificial intelligence. And that's really coming in as a strong offering so that customers can not only build a great foundation, but also overlay the right software characteristics on top of that.
I really like the line that you had in your conference call where you talked about the key is observability, which I know because of cybersecurity and many of the companies we deal with are so concerned that you said we cannot secure what we cannot see. The other guys don't really offer that option, do they?
Not really. It's very difficult to see if you're not smack bang in the middle of the network where you're connecting to everything from users, IoT applications, AI infrastructure, et cetera. So we're in an ideal position to look at all the telemetry and observe everything and then take action on it. So I think the network position is a pivotal point and a critical junction for that.
I want to step back for a second for the people who aren't that familiar with what you do, other than just make a huge amount of money for people. If we did not have Arista, what would happen with all those great GPUs that we're reading about? What would happen with Blackwell? What would happen with the current iteration of what NVIDIA is doing?
I think, let me take you back 10 years when you and I first met. You almost asked me the same question then. At that time, we were powering the cloud. And as we talked, it was Satya's Azure, and all of the cloud networking that we powered now gives us a second chance to do this with AI. So, what NVIDIA is doing is now bringing these massive training workloads at billion parameters across GPUs. And these processors have to be utilized fully. They cost often billions of dollars. So any kind of idle state and 30% downtime costs them money. So without a good network, you can't have that utilization. And that's exactly where Arista comes in. We're building the absolute best-of-breed foundation for AI networking to make those GPUs hum and ignite better.
Well, look, I am all in, but I also am cognizant, as you know, that I believe in Jensen greatly. And he did talk on the last conference call about his own Ethernet networking space. He's launching new Spectrum X end-to-end offering designed for AI-optimized networking. And I started thinking, well, are you friend? Are you partner? Are you competitor with NVIDIA?
Well, I just want to say to Jensen personally, and of course NVIDIA as a company, we are first friends. Majority of his business, we don't compete with at all. Of course, there's about 1% of his business that may be overlapped with our business, but I would hardly call 1% anything but friendship and slight overlap.
Well,
so
all right.
We'll compete where we have to, but we're friends for most part.
Now, people say to me, wait a second, is Broadcom, which happens to be positioned by Chestone, are they competitors? I see them as being actually key cogs with you. I don't know. I think that might be a good way to put it.
I think one of the beauties of Arista's differentiation has not only been our operating system, but working with merchant silicon chips. Broadcom being one of the best portfolios we've seen in the industry. We certainly work with all of them, but we have done our most work with Broadcom. So again, a case of a great partner and friend.
All right, now a lot of people care about momentum. I'm more caring about value, but you give us both because you've been buying back stock, which tells me that, and you, of course, the stock is above where you bought back, but also the visibility you had. In November, I know that you felt that things were a little bit murky. The view that you gave in that recent quarter made me feel like, you know what, you have more visibility than most companies right now in technology.
Yeah, I think I feel a little blessed there. In November, we were kind of wondering, is the cloud going to pivot to AI? Does that mean they spend less on cloud? And I think the entire cloud CapEx was still a little bit of a question mark. But today, I'm most proud to say we have momentum in 3 sectors. The enterprise, including the campus, the specialty cloud providers who are building some of their own specialized workloads, and then, of course, the core cloud titans and AI titans. I think our visibility has gotten good across all 3, and it gives us a great deal of satisfaction that we can satisfy all 3 markets appropriately.
Which leaves me with the thing I wanted to bring up initially that I didn't, and I should have. The term Titan is fantastic. Now, people tell me when it comes to you, we should just be speaking about Meta and Microsoft. And I come back and I say that all the Titans use you, from what I can tell. And that I should be using the term Titan and not hyperscaler. What do you think?
Well, I think you can use your term. I clearly love the word Titan so much. I not only use it for cloud, we now have a new class of AI Titans coming up. So whatever the term, I think the most important thing to remember is they're the most demanding customers. M&M especially. I like candy, but I like M&M as our customers even more.
And the last thing, you just authorized a new buyback. I am sure there's some people who say, well, wait a second. Jim, you think Jayshree's so great, you think that the company's so great, they should be building the next big thing. But you are kind of the next big thing, and you still think your stock is cheap, obviously, with a buyback.
I think part of being a growth company and being a responsible company to our shareholders is to keep providing value. One aspect of value is good results and good stock returns. And the other aspect of value is to believe in our own stock. And our last buyback expired, and Chantel, my new CFO, and myself thought this was a perfect time to get another authorization from our board of directors.
Well, I think that your analysis of what people should look for in a stock is sorely wanting away from you in the technology cohort. It's great to see you stand for so much that's good for shareholders as well as for technology and for great leadership. That is Jayshree Ullal, Chair, President, CEO of Arista Network. The symbol is ANET. They just bought back a ton of stock. I think maybe you should join them. Mad Money's back after the break.
Coming up, Cramer quenches your thirst for stocks. It's a battle of the beverages when Mad Money returns.
Has Wall Street finally lost its appetite for the energy drink stocks? I mean, here's a group that's had some stunning performance over the last 20 years. You think Alphabet's up big from its 2004 IPO with that 7,890% gain? Man, if you bought Hanson Natural, which is the company that became Monster Beverage at the same time, you'd now be up more than 24,000%. Meanwhile, in just the last 4 years, Celsius has rallied more than 4,700%. These things have been incredible winners. I mean, you think that they're AI, you think that they're, I don't know, networking or something. But in March and April, both Monster and Celsius turned ice cold, along with so many other formerly beloved growth stocks. Monster was down more than 15% in just over a month before stabilizing in the low 50s, ahead of its most recent earnings report last Thursday. Celsius plunged over 30% from peak to trough. I was starting to lose faith here. It rebounded a bit going into this quarter on Tuesday. So when we saw the actual numbers, did these declines turn out to be justified? Let's start with Monster, which has given the bears a lot of ammunition over the past year. After the company last reported in late February, its stock shot to a new all-time high in mid-March, but the fourth quarter results actually weren't that good. In fact, they missed on nearly every line. Monster only rallied in response to the quarter for one reason. They told us that their currency-adjusted sales growth had accelerated to 20% in January, which was very impressive. But after the stock peaked and rolled over in March, sentiment quickly turned negative again. It reached a crescendo on April 25th, a week before Monster's first quarter report, when two analysts downgraded the stock on the same day. Hey, one of these truists even hit the one with the dreaded double downgrade that you hear about. That they go from buy to sell. They don't stop at hold, arguing that margin expectations were too high. Stock was simply overvalued. So what happened when Monster reported a week ago? You might think they proved the skeptics wrong because the stock rallied 3% the next day, but that's actually not true. Monster's currency-adjusted sales growth came in at 15.6%, which would have been fine, except everyone got excited about that 20% growth number for January, meaning there was a major decel, as we call it, deceleration in February and March. Net sales were in line. Their gross margin improved a bit year over year, but Monster's operating expenses were also quite a bit higher than expected, and these guys missed on all the earnings lines. While Monster doesn't give much formal guidance, the company did disclose the currency-adjusted sales grew by 12.9% in April. Clearly, things are slowing down. I didn't like that. All in all, not good. So why did the stock rally in response to the quarter? Two reasons. First, expectations were relatively low going into the quarter, and the headline numbers weren't horrible, even if I can't call them good either. Second, Monster announced, and this was really interesting, a modified Dutch auction-style buyback for up to $3 billion of its own stock. In other words, they thought their stock's very undervalued, which is a substantial chunk of change for a $57 billion company. That said, worth noting, both co-CEOs intend to sell some of their shares back to the company. By itself, insider selling doesn't necessarily mean anything, but it's definitely not a positive sign. Take away the buyback announcement, and I think Monster would have sold off a lot. Celsius, though, is different. From mid-March to late April, the stock lost more than 30% of its value, which was breathtaking. That was largely because Celsius announced an amended distribution agreement with PepsiCo, which they already had an existing agreement with, and it says to quote, and I'm going to quote here, it's a little confusing. I was confused when it came out. Incentivize and compensate the distributor for its continued focus on the end actions to support, quote, end quote, Celsius products. Nobody knew exactly what that meant. I sure didn't, but the analysts assumed that more compensation for PepsiCo is bad news for Celsius. The stock actually dropped 8.5% on the news as people sold first, asked questions later. Fast forward to Tuesday morning when Celsius reported its first quarter results. At first glance, it looked like a mixed quarter. This company posted a substantial revenue miss. They did under $356 million in sales when Wall Street was looking for $390 million, but the margins were fantastic. Celsius' gross margin expanded by 740 basis points year over year, much higher than expected, which translated into a 7-cent earnings beat off 20-cent basis. I like that. These guys had 108% earnings per share growth year over year. Now, on the conference call, management said the revenue hit came from, and I quote, inventory movements, end quote. So hard to understand, for their largest distributor, which is PepsiCo, which, again, I told you, owns a stake in this company. Long story short, Pepsi had a big restock in the first quarter of last year that didn't repeat itself this year. Celsius also indicated that PepsiCo plans to keep its inventory tighter this year. That's not great news, especially since we don't know how long this will last. But it's a legitimate explanation for the revenue shortfall, and crucially, it's got nothing to do with demand, which is what I care about. Once the analysts update their forecast to account for PepsiCo's planned inventory changes, I bet Celsius will be just fine going forward, because other than that one issue, business is real good. Although Celsius doesn't give much in the way of formal guidance, management reiterated a previously stated goal of getting their full-year gross margins to the high 40s. Perhaps that was a disappointment because their first quarter gross margin was in the low 50s. But the CFO noted that they're taking a conservative approach to forecasting the remainder of the year, thanks to the possibility of rising costs. I get that. I don't see the costs rising. Plus, there are plenty of positives here. Celsius continues to take market share in the energy drink category, reaching 11.4% by the end of the first quarter. Now, that's up a full point. That's a lot from the fourth quarter and up 4 points from the same point last year. That's huge. Hey, by the way, as Celsius steadily gains market share, the top two players in the space, Red Bull and Monster, keep losing share. On top of that, management sounded an optimistic tone, although they always are optimists, about the spring shelf reset season. Now, that's something we've recently seen about when we talk about Constellation Brands, which expects to see big shelf gains from Modelo this year, thanks to the success last year. Celsius expects big shelf gains, too. Possibly the best in the company's history. Once you gain shelf space, obviously your numbers could go higher. Finally, Celsius has only just started to expand internationally. Canada's sales began in January, the UK and Ireland last month, France, Australia, and New Zealand are all coming up in the fourth quarter. Could be a major source of upside surprise over time. Ultimately, the sales miss and PepsiCo's inventory noise, coupled with management's decision not to commit to a higher gross margin target for the full year, led to a modestly negative reaction to Celsius' quarter, stock slipping 1.8% on Tuesday. But after looking into the quarter, I'm pretty sanguine about the situation, and I guess so is the rest of the street. It's come around to our view as CELH shares jumped more than 6% today. I mean, I'm sure there are some people out there who must be thinking that PepsiCo wants to buy the rest of them or something. By the way, if I were PepsiCo, I would want to buy the rest of them too, because this is a growth category. Hence, here's the bottom line. Monster saw a small bounce when it reported, but mostly because it also announced a big buyback. I'm not particularly impressed with the latest numbers. Celsius, on the other hand, which is a company I've liked for a long time, they've been on many times, gave us a noisy quarter that masked the true strength of the business. The market's now giving the company credit for the result, but the stock's still down about 18% from its highs. I think this is a very good entry point, even though I don't like it up 6 today. At the end of the day, though, you want to own shares of the company that's taking market share like Celsius, not the ones that are losing share like Monster. And I got to tell you, when it comes to taste, which of course there's no accounting for, count me in as a Celsius drinker. Only after 4 cups of coffee. Let's go to Brian in Wisconsin. Brian.
Hello, Jim. How you doing?
I am doing fine. How you doing, champ?
We're doing good. We're doing good. Thanks for taking the call and for all you do. See, my
no
question
problemo.
is on ConAgra. They've had a lot of ups and downs and changes over the last 8-10 years. Wondering what your outlook is for CGA.
Okay, thank you for the call. Now, here's what I'm going to tell you. Sean Connolly has got a decent hand. They're not the greatest brands, but it yields 4.5%, sells at 11 times earnings. I am never going to criticize anyone for buying with those characteristics. I think you'll be fine. Let's go to Scott in my home state of New Jersey. Scott.
Jim Cramer, I've been watching you since you started on television.
And you're certainly you might be 70.
Yes, I am.
All right, good enough.
You for all the wisdom that you've imparted to
I appreciate that. Thank you.
Years.
Thank
and
you.
how about those Phillies, Jim? How about those
best
Phillies?
team in baseball? Thank you for mentioning it. Last night lost, but that's okay. We just sweat. I mean, they're bringing great joy to my household. Let's put it that way. So how can I help?
They're bringing great joy to us down here in Margate land as well. So.
Oh my God, Margate! Oh my God! You know, Jeff Marks, my partner in crime, he goes down to Margate all the time. Yet I used to be friends with Lucy. I don't know if you know who Lucy is, but
Lucy's right around the corner from me. I
my
look
girlfriend.
At her rear every day. I see it from my building here.
That happens to be a giant elephant. Let's not make any conclusions. All right, let's get to work. Maybe we get to work. Maybe we stay more focused. I'm sorry.
Here we go. Get to work. CVS. I've been taking a beating on my CVS stock. What do you think, Jim?
Oh, geez. You know, I think the world of Karen Lynch. I think it yields 5%, but they're in a very hard category. They're trying to make healthcare work. They're trying to make the small format stores work. They have to deal with the current stores and the problem against Amazon. It may be too much for her to handle, but if she wants to come on and talk, I more than welcome it because she's cerebral and she's got a plan. So that's my goal, but that's, the jury's still out on that one. All right, guys, when it comes to the energy drink category, which I care about passionately, you want to own shares of Celsius because they're gaining share. Unfortunately, Monster is not gaining share, and I don't know. It's kind of orphaned right here. Right, much more Mad Money, including a really cool piece that we've worked on about retail REITs. I want you to know which ones are the greatest. You also get some yield. That works all the time. Then I'm focusing on the crux of what's become a great debate around the Fed's next move. You do not want to miss this one. And of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. As we've seen more signs of a slowing economy this earnings season, not to mention clear indications that the Fed's taken notice last week, the bond market's done what it always does at these moments. long-term Treasury yields have come down. The benchmark 10-year yield has gone from 4.735% on April 25th to less than 4.46% today. This despite a huge bond auction that could have crushed the market if there weren't such voracious demand. So what do? What's the playbook for a world where long rates are finally coming down thanks to a weaker economy? Like I mentioned last night, this might be a real good moment to buy some real estate investment trusts, or REITs for short, because they tend to have high dividend yields, making them direct competitors to the bond market. When Treasury yields go down, these dividend REITs get more attractive. Difference, REITs can, of course, have actual capital appreciation at these levels, not just fixed income. Now, the REITs were clobbered in the first 4 months of the year as rates rebounded, and the retail REITs were hit particularly hard because everyone was worried that the consumers tapped out. But if rates keep going in the right direction, all considering those brown shoots I keep talking about, they will, then this could be the perfect time for you to get some retail REIT exposure, provided you go with the right ones, which is why I'm going to go over the right ones. First, if you're worried about an overstretched consumer, I want you to consider Tanger. That's the old Tanger factory outlet stores. Tanger's the chain of outlet centers with incredible bargains. We had them on the show last week. As Tanger CEO Stephen Yoloff can say much better than I am, well, just take a look.
I think what makes the shopping experience in an outlet center so exciting for the consumer is that customer is aspirational. That's a customer that might come in thinking that they can only afford a certain price point, but if they're in that outlet environment, all brands become accessible to them because they're on sale every day. So you might have thought that Coach or Kate Spade or Michael Kors was out of reach. But when you walk into that store, because the sign outside says everyday pricing 40% off, all of a sudden it becomes reachable. And you might have aspired to buy into that product your entire life, and now you have the opportunity to do so in our portfolio.
Might have to send the FTC chief over to one of those Tanger outlets, huh? All right. Anyway. Tanger's outlet centers still have strong traffic, and retailers can't get enough of those locations. In fact, these guys have an extremely high-quality problem. Demand for space in Tanger's center is currently so strong that the company had to change its strategy. Get this. Previously, they almost always re-signed old tenants whose leases were expiring. Maybe they put through a small rent increase, but the tenant rarely got kicked out. Now, though, Tanger's being more selective. They won't renew the lease for underperforming tenants anymore if they can find someone better, someone whose stores could boost traffic for the rest of the outlet center. That might temporarily lead to lower occupancy rates near term. But long term, I think it's a really good strategy. Either way, you know Tanger's in good shape when there are practically bidding wars for these outlet spaces. That said, stock actually got hit after Tanger reported a seemingly mixed quarter a little over a week ago. Investors focused on the slightly lower than expected occupancy rate while ignoring robust funds from operations, the REIT equivalent of earnings, and a terrific 5.2% increase same-store sales net income. That was nice. Look, I think the quarter was really good, and the stock's enticing at these levels. It's got a nearly 4% yield here, which I'm betting will get more enticing as the slower economy pushes bond yields lower. This is a terrific growth story. What's next? Okay, how about good old Simon Property Group, the number one owner of higher-end mall properties in America, increasingly the world? Simon's been written off repeatedly over the past couple of decades. Why? Because, of course, everyone thinks the mall's dead. I know the mall ain't what it used to be, but reports of its demise are wildly overstated, particularly Simon Properties Mall. And this company has done some very creative things to keep its malls breathing and not thriving. Back during the pandemic, when quite a few retailers went under thanks to lockdowns, Simon, the landlord, partnered with Authentic Brands Group to buy up some better brands out of bankruptcy. The goal was to simply keep their tenants alive. They did it with Aeropostale, Brooks Brothers, Eddie Bauer, Forever 21, Nautica, Reebok, and even JCPenney in a separate deal. Yeah, they're still around. Just last month, Simon did something very similar, buying up Express with some partners after it filed for bankruptcy. That prevented Simon from being hit with a huge wave of vacancies at the worst possible time. You hate going to the mall with just all those blank spaces, right? Makes you feel kind of like, what am I doing here? And once we came out of the pandemic, these retailers came right back, turning out to be great investments. Over the past few quarters, Simon has been opportunistically selling their stakes in these brands, locking in major profits in the process. Now, these guys reported a stellar quarter on Monday after the close. Really good. Simon Property generated $3.56 of funds from operations per share, up 30% year over year. Wall Street was only looking for $2.81. Nice beat. They raised the full-year funds from operations forecast substantially, too. The big beat happened because Simon made a bundle selling their remaining position in the Authentic Brands Group, which they got as part of the retail acquisition joint venture. And even putting that aside, the core business is doing quite well. Better than expected occupancy rate, better than expected base minimum rent per square foot, not to mention 3.7% same-store sales net operating income growth. So in response, people realize this. Sometimes people are slow to understand these companies, but this time the stock rallied immediately 2.4%. It's still basically trading though where it was last December. Plus, Simon currently sports a bountiful 5.4% dividend yield, and they tend to raise their payout frequently. They've done it 4 times in the last 5 quarters. Now, I would be a buyer right here because I think all systems are go for David Simon's company. You want to own this stock. Income, even some growth. Finally, there's Federal Realty. Look, we had them on last night. These guys own mainly mixed-use properties in wealthy suburbs along the coast. What can I say about this outfit? Every time I speak to CEO Don Wood, I come away impressed. And we've been speaking to him for almost 20 years. Federal Realty's embrace of mixed-use properties means their real estate often at the center of any given community. Their focus on rich suburbs means we don't have to worry about cash-strapped, lower-income consumers. When Federal Realty reported last Thursday, it was right down the middle of the fairway, okay, with inline funds from operations and a small increase to their full-year funds from operations guidance and an inline occupancy rate. Most encouragingly, though, Federal Realty reported record levels of leasing in the first quarter, and they're seeing big rent increases when they sign new tenants. Meanwhile, the company pays a 4.25% dividend yield, and this is the most consistent payer in the entire REIT space. 56 consecutive years of dividend boosts. How about that? In a world of brown shoots, that kind of dependability should earn the stock a premium multiple, which is why I like Federal Realty. You want consistency and discipline? Federal Realty is for you. So let me give you the bottom line here. If you believe that rates are ultimately headed lower this year and that the decline's finally begun, then you might think about buying a REIT. You want REIT exposure because dividend stocks are about to get more attractive. Right now, I think you're getting some good deals on quality retail REIT merchandise like Tanger, where you've got all those great outlet brands, including some that are trying to merge with each other, and Federal Realty and, yes, Simon Property. Now, I bet any one of these is going to be good for your portfolio. They are the best in the retail REIT industry. You know what? They may be the best in the entire REIT business itself. Mad Money's back after the break.
When we return, master the markets one stock at a time. The lightning round is up next.
Time for the Light Round Crypto Events, where Rob Gold's costing the same stock started by passengers, but know the core stock done by 10 friends by the Blood. And then the lightning round is over. Are you ready, Ski Daddy? Time for the Light Round Crypto Events. I'm Douglas in my home state, New Jersey. Douglas.
Hey, Jim, how you doing?
I'm doing well, Douglas. How about you?
I am doing great. I just want to get your thoughts on AMD.
Oh, Lisa Sue's doing a terrific job. There's room for both Lisa Sue and Jensen Huang from NVIDIA. Let's do some buying. I want to go to Michael in Tennessee. Michael.
Hello, Jim. This is Mike Clements. I would like your thoughts on the copper mining stocks, in particular Southern Copper Corporation.
That is a very good company. It has moved up a great deal as people realize that we need more copper in data centers. I would not necessarily purchase some here. I'd like it to come down a little. Matt Horween, my writing partner, found this for me at 80, so I'm conscious it can still go lower before it goes higher. How about Kyle, Pennsylvania? Kyle.
Too chill. Enjoy Saquon in your lineup.
Which one?
Enjoy Saquon in your lineup. Barkley.
Oh, Saquon's fantastic. He's a leader. He's a leader of men. He's a leader of men.
Yes.
He will be. I hope he calls the plays, actually. Go ahead. Do.
It's going to be a great season for you. I'm calling in regards to a company you referred to as a second-rate Logitech, and that's Corsair. And that's on news of the recent acquisition of Fanatec, the leading racing simulator equipment company out of Germany, adding yet another line of peripherals to their consumer discretionary line. What are your thoughts on this former SPAC, especially at a $10 value?
Jeez, I don't know, Kyle. I think that Corsair is a second-rate Logitech. Okay, let's go to Barry in Florida. Barry. It's probably Barry. Barry.
Hey, Jim.
Yo.
Hey, Jim.
Yeah, Barry.
You with me, Jim?
Are you with me, Barry?
I'm with you, Jim. I'm a real estate broker down here in Miami. The market's great. Everything's good. My favorite REIT is Starwood Properties Trust. Everything looks good. But are there headwinds from this commercial lending?
Here's the problem. Your namesake, Barry, is on TV every minute telling us that this is like the worst possible market, and yet he's in one of these things. So he has talked me. Barry's sure they come like he has talked, and an Eagle fan, by the way, has talked me out of owning a stock. I wanted to own it. I thought it was good. I like the yield. I like the guy. But he has single-handedly just told me, Jim, you shouldn't own my stock. That's the way I look at it. Nothing I can do. So, Barry, I'm sorry. I wanted to buy it, but you win. Let's go to Chuck in Arizona. Chuck.
Sir James Cramer, the Wolf of Wall Street. Woo!
I don't know if that's good or bad. How can I help?
Like the baby song, I'm back on the street again. I'm back on the air again, Jim. XPO reported last week and beat on the top and the bottom line, but yet
they're a serial beater. No, they're a serial beater. It's good. The stock is really good. The company's really good. I would own it. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, no such thing as a new normal. Cramer checks in on the downstream effects of COVID on the consumer. Next.
If you want to know the Fed's next move, you need to figure out if the consumer's feeling poorer or if people are just moving on from their post-pandemic behavior, returning to normalcy. Let me explain. We tend to overlook it these days, but COVID changed practically everything. Work from home went from being an exigency to being an accepted alternative to working in the office. People put off non-urgent surgery for fear that they might come down with COVID. So many people held off on necessary procedures that we're still getting a surgery boom as they play catch-up. But there's been nothing like what happened to travel. During the pandemic, we recognized that life was too short. Many of us went a little stir-crazy, which led to a travel boom once we got over COVID. Every flight was full. Expedia and Booking Holdings put up amazing numbers. The cost of a hotel room skyrocketed, and Airbnb's numbers roared as the cheaper alternative. Yeah, let's all be getting to unwind. Many people are coming back to the office more than 2 or 3 days a week. We're not building new home offices anymore. The hospitals are jammed. The biggest normalization, though, as Wall Street calls it, might be in travel. And it's shaking investors to the core. Hardly a day goes by where we don't hear a report that travel is cooled. Today we got two. First, Hyatt cut its forecast going forward. Then Airbnb shaded things down for this current quarter, concerned that business might not be as robust as people expected. Both stocks were hit hard at the open today, although Hyatt later recovered because they were part of what I guess Wall Street still calls that revenge travel or long on money, short on time thesis as I do. Now, I got to wonder whether Disney, which reported a smaller dip in expectations for theme park visitations, and Expedia, which blamed its weakness on tech problems, are really confirming that domestic travel slowdown that I see. Booking Holdings, which saw some slowing in domestic travel demand, blamed it on normalization. The post-COVID period is over, and the travel slowdown started in the United States. We were the first ones to beat the pandemic. It'll probably finish in China because they were the last. China's still traveling for now, which is why Wynn Resorts could deliver terrific numbers from its Macau business. That is one reason why we own it for the Travel Trust. Bought some more yesterday. Still like it here. As I see it, where there's smoke, well, there's fire. Travel has peaked, but I'm not willing to say that the consumer has peaked or is done spending. We have a lull. It's a moment where, kind of in time where there may be nothing compelling to do. We'll soon get retail earnings. I feel they'll be fine. Nothing great, nothing bad. We saw Costco's numbers today, and they were strong. But let's not forget that Costco's the bargain hunter's heaven. Now, in the short run, it doesn't matter whether the consumer is traveling or not. What matters is whether there's less spending on travel and whether the Fed notices it. Take it as one more sign that consumers being less extravagant, which is what leads to inflation. A normalized consumer is one who's reacting to higher prices with rationality, choosing not to pay for things when they get too expensive, going on strike. And that's how prices come down. When prices come down, we get less inflation. And with less inflation, the Fed can at last cut interest rates. It's called the business cycle, and it will never be repealed, even by COVID. So I can only conclude that while the companies that thrive on travel may be hurt, it's about time the consumer went on strike. In the end, only the consumer can control pricing by simply choosing not to spend as aggressively. And if you're Jay Powell, that is exactly what you want to see. I like to say there's always a bull market somewhere. And I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.